Hello everyone, this is Mike Secreta. I'm the founder of FAN, the Financial Advisor Network. Want to welcome you to today's session. I'm very excited about this session because there's so many times we're looking for ways to get our prospects, get our clients to not focus on performance, because it's always a difficult battle because of course there's costs associated with our managing their money, the cost of the investments, our costs, and trying to have them compare that to the S&P 500 or something that has no costs associated with it is real difficult. So this session is on risk, the whole risk management process or analysis of our prospects' portfolios, of our clients' portfolios, and how to use that as a way to obtain clients, to keep the clients we have, and also get more of our clients' money, because we know our clients aren't just using us. They have money elsewhere and with other advisors, with other companies that they're investing in. Now I'm working remotely, so if we could switch to the next slide. Okay, so a number of our fan members had said to me that they really love when we bring in an outside expert. So I think you're going to be very pleased with our outside expert today, Philip Wilson. And Philip, I'll let you say hello and introduce yourself, give us your background in terms of your work with risk management.
All right. Well, good afternoon, everybody. Yes, I've been in the investment business since around 1964. Spent many years advising major institutions like Sears, Allstate, Bank of America, University of Chicago, and others on investment strategy. And of course, at that time and on an ongoing basis, risk was always one of the primary considerations in making any investment decision, more so even than returns. So I still think it's very important. It's something that all too many advisors don't get involved with, but at the institutional level, that has always been one of the primary criteria. So, okay, Michael.
Great, thanks. Yes, you have tremendous background. I know you're going to be giving us a lot of great insight. Now, Phil's the CEO of AdvisoryWorld. I found out about AdvisoryWorld really through my work with the Financial Advisor Network and our members, and they have some great risk assessment tools, risk analysis tools, and reporting tools that advisors use with their prospects. Some even are able to charge extra for that. And I'm just impressed with the fact that, you know, the tools they do have, and they have what I call a try harder approach versus some of the competitors out there in terms of just having better tools, having it work easier, and of course doing it much cheaper. So that's really great to see with what they're offering people. And then me, I'm your moderator today. You know who I am. I started the Financial Advisor Network over 5 years ago. We now have over 11,000 advisor members, and because of your request to keep it to advisors, I screen out quite a few non-advisors. It's interesting that today I probably screen out for every one advisor that I let into the group, there's probably 3 non-advisors trying to get into the group. So anyway, you know, my experience over the past 30 years, my day job is helping financial advisors, helping financial firms be more successful. So just a few housekeeping items. Everyone's going to be muted just because it keeps all the distractions out. There's a message box to your right, chat box. If you could type in your questions as they come to mind, and then at the end, toward the end of the program, we will have a Q&A session. And also, we're going to be providing a recording to everyone, so don't feel like if you see a lot of great stats and information that Phil's showing on his slides, don't feel you have to copy them. So this way you could just focus on what Phil's covering and, you know, write down your questions when they come to you. So let's start, Phil. Kind of the topic of the day, if you will, is the U.S. government shutdown. There's a lot of things, you know, being said by the politicians, by the pundits in terms of what impact might it have, what's the risk to investors of it. So it would be great if you can share your thoughts on that.
Well, first of all, I love your picture with the lightning on the Capitol building. I think that's very appropriate. I only wish you. Never mind. I'm not going to go into there. Yeah, I think the shutdown is interesting. I don't think from a market risk standpoint that there's much risk entailed in it. Most of the risk is because of the confusion and the lack of understanding what's actually happening here. But in terms of actual economic and market risk, I don't think there's very much. From a historical standpoint, we've gone through this like 17 times. Typically over a 30-day period, if it's shut down, you see maybe 1 to 0.2% decline in GDP. You know, that could be of interest, but it's not material, I don't think, in terms of market risk. And that's really what our clients are interested in. You've got your thoughts for clients, Mike. I think that's a good point. I think it probably is incumbent upon every advisor to at least contact the clients, talk to them a little bit about it. I think you can assuage their fears. Same kind of thing, and I have a slide on this coming up, but in terms of the not just the budget, but the going into default, I don't think that's particularly interesting. The U.S. government will never go into default. They do have the power of the printing press, can always print money. They're always going to pay interest on the debt. Of course, if you don't pay interest, you default. If you do pay interest, you don't default. And I'm certain this government is never going to default, no matter what happens with this debt ceiling. So I don't think there's a lot of risk there either. You know, people in the markets on the floor, and I was a specialist on the floor for a number of years as well. They tend to get a little nervous from time to time, but I think over the long term or intermediate term, we're not looking at a lot of risk in any of these issues. In terms of the Federal Reserve printing up to $80 billion a month to support, if you will, the Treasury's interest rates, keeping them low and that kind of thing, that could be a serious risk issue. When they stop doing that, that means money that was otherwise not going into Treasuries will now, and went into the marketplace, the stock market, won't go into the stock market anymore. So a lot of the money that has been going in is going to be taken out. So, you know, when the Fed does cut back on that, I do think we have some serious risk issues, market risk, price risk, that kind of thing.
So that's, you're talking about the quantitative easing and coming to an end, or the tapering off of that, yeah, which of course had nothing to do with the shutdown, as you said, with that. Okay, well that's good points and good reassurance for us and for our clients, and I agree with you that having that kind of conversation with your clients, sometimes the best thing you can do from a standpoint of generating loyalty and getting referrals is to call somebody, call up a client and say, hey, everything's under control, don't worry. So, because the fact of the matter is they're probably not getting those calls from their other advisors, from their other professionals. So that's good to do. So if you just jump to the next slide. So again, what we're trying to cover today is let's get people focused on something other than just performance. And that's what we're going to cover today. Before we do that, we have a couple of survey questions we'd like to ask the audience. So if we could pull up the first one. Real simple, yes or no. Do you currently do any kind of risk analysis for your clients and for your prospects? So if you just quickly click on those. Which one? And this is going to help us with work we do, other seminars that we do, newsletters, information to help our financial advisor network members and other advisors as well. Okay, now let's go to the next question. So how important is risk sensitivity when making investment decisions for your clients? So is this something that you're looking at very carefully, important but not your first concern, not very important, or has zero impact? Okay, great. Thanks for your answers to that. So Phil, I'll turn it over to you, and you can cover your view of risk analysis for portfolios.
All right. I hope you can see my screen now. Can you, Mike? Todd?
Yeah, you need to put it in slide presentation mode. Oh, that's fine.
All right. You can see the screen now, right?
Yeah, people can still see it. That's good.
Okay. All right. Yeah, you know, I'm too old for all this technology to get through all these things. All right. Number one, managing investment risk. I think that's really a primary thing of interest here. Risk aversion. Clients, every client, whether it's an institutional or an individual client, is inherently risk averse. They're willing to accept risk, as you all know, that will compensate for the return, that will compensate for the risk they're willing to take. But they are certainly more concerned with risk than they are with the rewards. Let me give you an example. A number of years ago, quite a number of years ago, in Chicago, there was an $87 million pension fund, came to me to analyze the performance characteristics of their portfolio. And it turned out that they were risking the loss of 9.1% of their principal in any 12-month period. Well, regardless of the returns, 9.1% downside risk was unacceptable to them. And consequently, we were able to get the business and do a pretty good job for them for a number of years. So the criteria for them was, oh, all right. One of the kids just came in and set this up. Thank you very much. I appreciate that. So in the case of certainly an institutional level, risk is far more important than the return. But the problem has always been, how do you quantify that risk? How do you deal with it in terms of the client? It's not an easy question, but when we're talking about risk, we're generally talking about what is the risk of loss of principal in any 12-month period. And you need to be very specific about that. You don't want to be generic in talking to clients about risk in terms, you know, like, well, I'm a growth and income investor, or I'm conservative. That's not particularly relevant. But, you know, the classic example is a client who says, I want a 20% return, but I don't want to take any risk. Well, that's not particularly realistic. So the quantification of risk, talk to a client. If you lose 15% of your principal in the next 12 months due to market conditions or whatever the situation might be, like in 2008, are you still going to hire me as your advisor? If the answer to that is no, then you need to work your way down. But it's really important for not only you, but for the client to understand what their tolerance for risk is. In our case, we've created a questionnaire, which we can make available to you if you'd like. It's a questionnaire we've used for over 20 years very successfully with clients. The whole idea is to say, okay, let's assume that you're a growth and income type of investor, and what we've done is we've assigned a downside risk matrix, if you will, to that category. So if a client says, I'm growth and income, and I'm willing to accept something in the area of a 5.25% downside risk, then that's wonderful, and now we understand specifically where they are in terms of their ability to accept risk vis-a-vis the return on the portfolio. So now we can do some quantification in terms of the return and the risk in the portfolio. In terms of measuring risk in a portfolio, the theoretical part is that the greater the security or portfolio beta, i.e. the R squared, the greater the risk in the portfolio. And so you need to understand and be able to quantify the beta characteristics of the portfolio vis-a-vis probably some blended benchmark, which of course in our Scanalytics application you can create blended benchmarks like 60% S&P 500, 30% debt, and 10% cash, or whatever it is that you want to create as a blended benchmark. And what's the regression of the portfolio that you're dealing with compared to that particular thing? The downside risk, or maximum drawdown as it's also called, is a measurement of, we do it at the 90% probability level. That means, at least from an historical standpoint, we can calculate using the standard deviation and returns of the portfolio what the 90% probability, what the upper and lower boundaries were of the portfolio. Take the mean rate of return plus 1.654 times the standard deviation. These are standard table calculations. That will give you the upside, 1.654 times rate of return, mean rate of return, less that number gives you the downside. In this particular case, as an example, the upper boundary of the portfolio would be 39.35%. The lower boundary of the portfolio would be minus 14.71%. Now, I can tell you pretty much from experience that if you're dealing with a balanced portfolio, downside risk of around 12% is extreme. That's a very aggressive posture. And remember, I'm not talking about the stock market like, again, 2008 where the stock market declined, over 30%, 35%. We're not talking about that. We're talking about a balanced portfolio. And in a balanced portfolio, ideally, you're going to have assets that are rising in value when others are declining. So you have ideally a negative correlation between the different investments in the portfolio so you can balance it out. The risk profile in this particular case we established for the client quantitatively was a downside of 5.25%. The actual drawdown, max drawdown for the portfolio was 14.71%. So it really gives you an opportunity to go back to the client and say, look, you're taking a lot more risk in this portfolio. Forget about the return for the time being. Maybe they got a 6% return and somewhere else they might have gotten a 7% return, but are you willing to accept that level of risk? That's really the question. And in this particular case, you can certainly go to the client and say, you know what, your current advisor is not doing a particularly good job of matching your tolerance for risk with the investment alternatives in the portfolio is established for you. And then, of course, you can tell them if you're using our tools, Scanalytics application or one of the others, that you can find a better portfolio vis-a-vis returns and risk. I'm sure all of you are considered with the theory of optimality, which is a modern portfolio theory calculation, if you will, using mean variance. And in this particular case, we're looking at the efficient frontier of all the possible portfolios that might be created using a set of investment alternatives. That set of investment alternatives is created by you, and you say, all right, I have these investments, or the client has these investments. What is the best, mathematically the best risk return that I can get out of this particular portfolio? The ideal, and I used to call this the get the check graph, because in our application we always provide the ability to optimize the portfolio. You get the efficient frontier, and you can compare the client's current portfolio, which in this case is A, to the optimal portfolio on the efficient frontier, which is O, and then B is the same rate of return for a lot less risk. So if a client says, I'm a lot more concerned with the risk here than I'm with the return, you can say then portfolio B is the optimal mix of the investments you currently have that will generate the same rate of return for a lot less risk. In this case, it's exaggerated quite a bit, but a lot less risk than you're currently taking. If you want the optimal return, you can get a better rate of return for your mix of assets than you're getting now for the same volatility characteristic. And that, of course, is really what the client is looking for. And in this particular case, the primary concern we have here is the risk the client is willing to take or is acceptable to them. Another way of looking at risk is what's called the zero beta capital market line, which is a theory that Bill Sharpe came out with a number of years ago, and I think it's quite valid. this assumes one of two things in terms of risk. Is the client, does he want to invest some portion of his asset in a risk-free asset, i.e. treasury bills, treasury notes, treasury bonds, that kind of thing? Or in the converse of that is if you're willing to borrow at a certain rate of return, what's the mix of investments I can have that's best going to support that borrowing? But in this particular case, A is the risk-free rate of return. The line is tangent to the efficient frontier, and at B, at the point where they meet, B is the optimal mix of the portfolio with X% in treasuries and Y% in the basket of portfolio assets that you would have at that point in time on the efficient frontier. And again, in this particular case, C is the client's current portfolio. Sorry about this. Okay. How much risk are they taking with their current investments? Another example in terms of marketing this. A number of years ago, a large mutual fund company sent out a 1 million-piece mailer to prospects. And all the mailer said was, would you have any interest in knowing how much risk you're taking with your current investments in the portfolio? They got over 300,000 responses to a 1 million-piece mailer, which tells me, it certainly told them, I have no idea how much money they made off of that, but it had to be very large. But it tells me that the risk, especially in today's marketplace, is by far the primary criteria investors have for making investment decisions. They want return, but they don't want to lose money. They see the volatility we've had over the last, really since 2000. That volatility is extreme compared to historical standards. And clients just simply aren't willing to accept that kind of risk. So I suggest to you, in terms of marketing yourself and marketing your business, the best way to do it is to approach it from a risk standpoint and show clients, demonstrate to clients clearly what level of risk they're taking compared to what level of risk and return you might be able to provide for them. So Mike, Todd, if you have any questions, we can go from there.
Sure. Yeah, I have a few questions here. You mentioned someone had asked for the questionnaire, if that could be sent to them. So what we'll just do is whoever signed up for this webinar, we'll send that questionnaire to them along with the link for the recording as well. If you're listening to this on the recording, just there's some contact information here. If you could just send an email or make a phone call to Todd Gallet, and he will get that questionnaire to you. Another question here is with the 90% probability you mentioned earlier. Is that using a Monte Carlo simulation?
No. Monte Carlo simulation is a totally different animal. What we're saying is, if I know what the mean, let's look back historically, if you will. If I look back 20 years, I can calculate what the mean historical rate of return was for a portfolio mix, okay? I can also calculate what the standard deviation or the volatility of returns around the mean has been. And when I determine that volatility, it's called a T statistic, but it's a simple table. And basically, the 90% probability means that 90% of the time, historically in this case, 90% of the time, the returns fell between the upper and lower boundaries that I showed you a few minutes ago. 5% of the time, the returns could have been worse. 5% of the time, the returns could have been better. Now, we've had clients in the past who want to go with a 99% probability, which is roughly 3 standard deviations. I think that's excessive. It implies a level of certainty that just simply doesn't exist in the real world. I've always been very uncomfortable with presenting that to a client. But 90% probability clients are pretty comfortable with. So we're dealing with that at an historic level. You can also do that from a forecasted level, and I recommend, in fact, I've done papers on optimization and doing it on a forecasted basis. But if you forecast returns and you apply a standard deviation, either from an historical point of view over 20 years, or maybe during an inflationary or deflationary period, or different market cycles, whatever you want, you find a standard deviation in terms of volatility that you're comfortable with, and you say, I think the forecasted returns for the different assets in the portfolio are going to give me a weighted mean return of X. Once I know that forecasted mean rate of return, and I've accepted a standard deviation or volatility for whatever period, for whatever reason, then I again can calculate a 90% probability of upper and lower boundaries for the client. And I can match that against their tolerance for risk. The other side of that is, this is a working model. I always like to use the example of taking a sailboat from San Francisco to Hawaii. You can't get there by setting a direct line. You can only get there by tacking with the winds, with the waves, with the currents, and all those kinds of things. So even when we do this, if we're forecasting returns and we're modeling a portfolio, you probably want to reevaluate, if not reoptimize, your positions on it's not a quarterly basis, certainly semi-annually. You need to review your assumptions. You need to review the risk and volatility of the portfolio as you're experiencing it, and see if it falls into the comfort zone, if you will, of the client.
Great, great. We had talked before, and I mentioned it about some advisors actually doing this analysis and charging a separate fee for it. Any thoughts on what kind of fees they are charging for that report using the scan analytics program you have?
Yeah, the scan analytics application. Yeah, let me get rid of this thing. Let me show you something. Here's a couple. In this particular case, this is a holding scan report. And you can bring this out. I've had clients charge anywhere from $500 to several $1,000s to clients just to analyze their current portfolio and say, you know, here's where you are, here's a benchmark, or here's the current portfolio, here's what I'm recommending, here's the standard deviation, these are the return characteristics of the benchmark and the model. In this particular case, the 3-year return has been 78.32% against 65.92 for the benchmark, which again is a blended benchmark. But this kind of report can instantly tell your client that they've got a problem. They have an issue they have to deal with. Another report that's a little more detailed in the Scananalytics application is the detailed analytics, if you will. This gets into things like Sharpe ratio, alphas, betas, R-squares. R-square is the regression, the tracking value, Sterling ratio, trainer ratio, max drawdown, downside. In this particular case, it's very large, tracking error, and so on. So, you know, these are really good basic reports that you can give to a client and say, you know what, I've analyzed your portfolio, $500. I don't know many clients, at least clients with a reasonable amount of capital, that wouldn't pay $500 or $1,000 to have their portfolio analyzed. Now, again, a lot of advisors simply do it on the come so they get the business. It's a great marketing tool either way.
Yeah, I mean, I've seen a lot of advisors, you know, be reluctant to charge for such a report, and you know, I've never heard any stories of people not hiring an advisor because of that. But if an advisor might be reluctant to maybe say, okay, normally I charge $500 or I charge $1,000 for this, but if you become my client, then there's no charge for it.
Sure. Absolutely.
So there's different ways to do it.
That's very valid, Michael. And let me just remind everybody here, if they don't know it already, your time is valuable. You tell a prospect that, you know, look, I'm going to take the time to analyze this portfolio, even though using our application probably doesn't take more than 10 or 15 minutes to be outside. I'm going to take the time to do this, and my knowledge, my experience, and my work is worth some money here. So another way, like you suggested, do it, say, I'll take, you know, it's $500 if you want a one-time thing, or $500 applied against your annual fees if you become a client.
Yeah. But yeah, the thing is, so many studies have shown that clients really are not as fee sensitive as we think they are. So this is a valuable tool to use. And what we've been able to do for the attendees of the session, including those who are watching the recording of it, is to get a 2-week free trial. So you can't beat that. to be able to use that, maybe you make money with some prospects and clients while you're getting the free trial. So you certainly can just write down this information, or we have a quick survey that we could pull up. If you're interested in that 2-week trial, just click that you're interested in it, and then you don't have to worry about emailing or calling or writing anything down. So if you could just do that quick poll, either way, would appreciate, even if it's a no. And as always with the Financial Advisor Network, always appreciate your feedback, want to hear what you thought of this particular webinar, as well as any additional webinars you'd like to see. We try to stick with the theme of helping our members get more clients, get more of their current clients' assets as well. So we're always looking for ideas to do that. So thanks again, everyone, for your time here. I know I learned a few things and got really excited by what was covered, and look forward to talking with some of you in the near future.